As an investor, based on investment goals, you can choose to invest in two kinds of mutual fund systems: growth-oriented and dividend-oriented. A growth-oriented mutual fund invests in a potential showing company stocks. The main goal of the investment is to achieve maximum capital appreciation. On the other hand, you can choose to invest in a dividend yield fund. The fund house invests in stocks of businesses paying a large dividend in this situation. These firms produce high earnings that enable dividends to be declared. Investments are therefore made in stocks of businesses that have proven track records of earnings being declared. If you've invested in dividend-oriented funds, you might want to learn about these dividend mutual funds. In this episode, we'll walk you through everything you need to know about dividend mutual funds, how it works, advantages and disadvantages, and the best 4 alternatives to dividend mutual funds. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best stocks that pay dividends regularly. How do dividend mutual funds work? In a dividend mutual fund, the fund house invests in stocks of companies that pay a high dividend. These companies generate high profits, which allow them to declare dividends. Therefore, investments are made in stocks of companies that have a proven track record of declaring profits. If you choose a dividend yield fund, the returns that you receive are the dividends declared by the underlying company. If the investor chooses this option, dividends are usually sent directly by the fund manager to the investor. The fund house is required to dispatch to the unit holders the dividend warrants within 30 days of the declaration of the dividend. In case of failure to dispatch the dividends within the stipulated time period, the fund house is liable to pay interest as specified by the regulator from time to time for the period of delay. You can also choose the Dividend Reinvestment Mutual Fund. This mutual fund gives an investor the choice of reinvesting the dividends received. The dividend can be used by the fund manager to buy more shares. Reinvesting the dividend increases the number of shares owned and results in higher returns as compared to the dividend yield option. Alternatives to dividend mutual funds. If you're looking to diversify your income investments away from just dividend mutual funds, here are some great alternatives. 1. Real estate investment trusts. Real estate investment trusts, or REITs, provide attractive yields and built-in inflation protection. While parts of the real estate market may be overvalued, there are many different types of REITs that provide exposure to different areas of the market. You can invest in residential or commercial real estate, as well as properties in different industries or locations. Of course, the performance of REITs depends on the wider real estate market. Residential rates have soared with the combination of low mortgage interest rates and stimulus checks, whereas commercial rates have struggled due to COVID-19 related shutdowns. Rising interest rates could also have a negative effect on real estate prices by increasing the cost of mortgage loans. 2. Closed-end funds. Closed-end funds, or CEFs, provide an attractive source of income from illiquid bonds or loans. Unlike open-ended funds, CEFs have a fixed number of shares that are bought and sold in the open market, which means they often sell at a discount to the underlying net asset value, or NAV. These dynamics could create an opportunity to acquire CEFs at an attractive valuation. The ability to purchase CEFs below NAV is also their greatest drawback. If you purchase a CEF, there's a chance it will drop below its NAV for a prolonged period of time, which means you may have to sell for less than the underlying assets are worth. Many CEFs also have less trading volume than more popular funds, which introduces some liquidity risk. 3. Preferred stock. Preferred stock, as its name implies, has preferential treatment over common stock. In addition to its liquidity preference in the event of bankruptcy, preferred stock has a fixed dividend that is paid out before any dividends are paid to common stock owners. These dividends also tend to be higher than common stock dividends, making them an attractive option for investors. The biggest risk of preferred stock is that they're callable. If interest rates fall, issuers might redeem preferred stock shares for the price specified in their prospectus and reissue new shares with lower dividend yields. If interest rates rise, the price of a preferred stock tends to fall as investors sell and seek better opportunities to generate income. 4. Income ETFs. Income-focused exchange-traded funds, or ETFs, and mutual funds are another option for income investors who want to avoid dividend stocks. While some of these funds invest in dividend stocks, many others focus on preferred stock, bonds, and other income-related securities. They also provide built-in diversification. Like any ETF or mutual fund, income funds have expense ratios that can impact long-term performance. Investors should also carefully consider a fund's portfolio, liquidity, turnover, and other risk factors before making an investment. Low-cost index funds tend to offer the best performance and the lowest cost of ownership. Pros and cons of dividend mutual funds. Dividend mutual funds come with lots of benefits, including most investors who invest in dividend mutual funds generally seek a source of revenue. Dividends provide a constant and safe payment to an investor from their investment in mutual funds. Dividend mutual funds are best suited for retired investors due to their income-generating nature. Dividend mutual funds tend to be less risky than other kinds of funds such as equity mutual funds. A stream of high dividends indicates that the company is performing very well. Dividends are tax-free at the hands of the investor. Dividends represent the distribution of profits among the shareholders and are treated as the income of the shareholders. Cons. Since dividends are linked to profits of the company, an investor should only pick those dividend mutual funds which invest in profit-making companies. It's important to check the historical data of the dividend declaration of such companies before making an investment. A very high dividend declaration can indicate that the company does not have enough opportunity to expand. These funds do not perform well in bullish markets. There's also a tax implication associated with dividend mutual funds. It actually destroys your money because of the tax on dividends. The tax deductions reduce the amount of dividend or the returns you can earn from a dividend mutual fund. Depending on your requirement as an investor, dividend options can be for you. Despite the taxation clause, a dividend payout can take care of liquidity needs. However, before investing, research various kinds of schemes and understand their implications on your financial portfolio. Frequently asked questions, FAQs. Before wrapping up this episode, here are answers to commonly asked questions by both professional and newbie investors. Is it better to take dividends or reinvest? As long as a company continues to thrive and your portfolio is well balanced, reinvesting dividends will benefit you more than taking the cash will. But when a company is struggling or when a portfolio becomes unbalanced, taking the cash and investing the money elsewhere may make more sense. Are dividend mutual funds a good idea? Dividend mutual funds are an excellent addition to just about any portfolio. Not only do they provide a steady income, but if the underlying fundamentals of the issuing companies are strong, they can also provide long-term capital appreciation. Which is better, growth or dividend mutual fund? The NAV of the growth option will always be higher than the dividend option because the profits reinvested in the growth option may grow in value over time. The total returns of growth options are usually higher than dividend options over sufficiently long investment horizons due to compounding effects. Do any mutual funds pay dividends? Many mutual funds offer aggregate dividends from multiple stocks that are either reinvested or paid out to account holders. Dividend funds are paid out after fees, meaning the best dividend mutual funds should have low expense ratios and high yields. Do mutual funds pay monthly dividends? All funds are legally required to distribute their accumulated dividends at least once a year. Those that are geared towards current income will pay dividends on a quarterly or even monthly basis, but many others only pay out dividends on an annual or semi-annual basis in order to minimize administrative costs. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes of financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.